Welcome to the deep dive. We take your sources and, well, pull out the key insights you really need.
Uh-huh.
Today, we're digging into a situation that's definitely got people talking. FiscalNote Holdings. That's NYSE ticker note. We got a good stack of your research articles notes here, and our mission really is to figure out what's actually going on behind that a pretty low share price and that NYSE non-compliance notice they got.
Yeah, it's definitely a complex one. It's what we'd probably call a special situation, maybe a turnaround story. We're here to sort of cut through the noise, you know, understand what FiscalNote actually does, this big strategic shift they're making, the financial picture,
Hmm.
and importantly, what the market seems to be thinking right now. And this is all based on the material you sent us.
Exactly. Think of this as your fast track to getting up to speed on FiscalNote. Oh, and before we jump in, quick reminder, you can like and subscribe to stockanalytics.ai. And for just Euro 4.99 a month, members can actually give us a ticker like Note and get a prioritized deep dive analysis, just like this one.
Good point. And definitely stick around because by the end, we're going to connect FiscalNote's big bet on AI, this whole turnaround strategy, connect it right back to why that share price is where it is
Yeah.
and what that might mean.
So the plan is, first, we'll unpack the business itself. Then we'll look at the management team, the people in charge, and break down the financials. After that, we'll explore what the market thinks, who owns the stock, the big risks, and then wrap it all up.
Sounds like a plan. And you can find all the sources we used for this deep dive listed down in the description.
Yep, and make sure you hit subscribe so you don't miss future deep dives like this.
Definitely.
All right, let's get started then. So, FiscalNote. What is it really? What problem are they trying to solve?
Okay, so at its core, FiscalNote is a technology company. They provide global policy and market intelligence. So imagine you're a big corporation or maybe a government agency, a law firm, and you need to constantly track, understand, and react to changes. Laws, regulations, political risks happening everywhere all the time.
Wow, yeah, that sounds like a nightmare to keep track of manually.
Exactly. It's incredibly complex. So FiscalNote uses, well, a combination of AI, huge data sets, and expert human insights to make that manageable for their clients.
So they're helping organizations sort of navigate this flood of policy information.
Precisely, yeah. They serve a really diverse global client base. Get this, over half of the Fortune 100 companies use them. Plus, government bodies, legal folks, public affairs professionals, basically anyone who needs to stay informed to make decisions and manage risk.
Okay. Now, the sources we have really emphasize this major transformation FiscalNote is going through. What's driving that? What does the shift actually look like?
Yeah, this is absolutely essential to understanding FiscalNote right now. They are actively, aggressively shedding parts of the business that aren't core to their future vision. The sources mention selling off things like Board.org, ISIL, Oxford Analytica, Dragonfly, Timebase.
Okay, so they're selling stuff off. Why? I mean, what's the end goal here?
Well, the main reasons are to streamline the company, number one. Number two, significantly cut down the debt they built up, probably from past acquisitions. And third, speed up their path to actually making money, profitability, and positive free cash flow. The idea is, by focusing only on the core AI-driven policy stuff, they can be smaller, yeah, but more efficient and financially healthier, much faster.
That makes sense. Kind of like shedding weight to move quicker. How do they actually make money from this core business then?
It's overwhelmingly subscription-based, like 92% of their revenue in the last couple of quarters, Q4 24, Q1 25, came from recurring subscriptions.
That's generally good, right? Predictable income.
Exactly. Predictability is key. They do have a smaller bit from advisory services or advertising, but that part's shrinking as they double down on the core tech platform.
Speaking of the platform, what's the key product they're really betting on for the future?
It's their flagship FiscalNote platform. This is where they're putting all their energy, integrating their AI, data, workflow tools, all of it. It's designed to be this AI-powered hub for policy intelligence. Sources mention things like an AI assistant, widgets using natural language, basically helping users track legislation, presidential actions, that kind of thing.
Okay.
And they're leveraging established brands they own too, like CQ and Roll Call, huge names in U.S. Congress News, Voter Voice for advocacy, Frontier View for market intel. Management's pushing really hard to get clients moved over to FiscalNote by 2026.
So FiscalNote is like the shiny new AI engine, but it's powered by the data and reputation from those older, trusted brands.
You got it. The older brands bring the credibility, the built-in customer base. Super important. But PolicyNote is where the innovation, the future growth strategy, is really centered.
And is there actually a growing market for this kind of service? What's the opportunity size?
Oh, yeah, it's significant and growing. The whole enterprise information space is massive.
Yeah.
Just the legal and regulatory part is estimated around, what, $40 billion?
Yeah.
And areas like regulatory compliance, legal tech, they're growing at solid mid to high single-digit rates. CAGR.
Okay. Solid growth.
But here's the potential kicker. The market specifically for AI-driven policy and governance tools. Some sources predict a, frankly, kind of eye-popping 40% plus KGR for that.
Wow, 40% plus. That's huge.
Huge potential tailwind, yeah. If FiscalNote can really grab a good chunk of it with PolicyNote.
But surely they aren't the only ones seeing this opportunity. How tough is the competition?
Oh, it's definitely intense, yeah. They're up against various players. Quorum comes up a lot as a strong competitor, especially in public affairs, advocacy software. Then you got the giants, right? LexisNexis Risk Solutions,
Yeah.
huge resources deep in compliance data, Bloomberg Government, particularly in the gov relations software space.
And probably smaller niche firms too.
Absolutely.
Yeah.
Lots of specialized players, and you always have the risk of bigger tech companies deciding to jump in more seriously.
So how does FiscalNote try to stand out? What's their moat, the thing that makes it hard for others to copy them?
Well, the sources point to a few things.
Yeah.
One is just the sheer cost and time it takes to build sophisticated AI and gather comprehensive global data. FiscalNote claims their decade-plus investment here is an advantage. Then there's brand recognition, CQ, roll call, those names carry weight.
Right, trust.
Exactly. And switching costs. Once a client integrates these tools deep into their daily workflow, it's a major pain, expensive too, to switch providers. So FiscalNote highlights their proprietary AI and data, those established brands, global coverage, and yeah, those implied switching costs.
But here's the thing. If you've got giants like LexisNexis also throwing money at AI, how does FiscalNote actually prove their AI is really better, more defensible, especially now that they're smaller after selling off assets?
That is the critical question, isn't it? Success really hinges on them proving PolicyNote offers something genuinely superior, stickier, harder to match. Not just, we have AI features too. Well, we'll need to watch user adoption, engagement, retention on PolicyNote itself. Those metrics will tell a real story about whether the AI differentiation is actually working in the market.
Okay, interesting dynamic. What about, let's take a hypothetical. New major U.S. tariffs in 2025. How might that affect a company like FiscalNote?
Yeah, the sources touched on this.
Yeah.
The direct impact on FiscalNote, being a software company, probably minimal.
Yeah.
They don't ship goods, right? The impact is indirect through their clients. On one hand, new tariffs could actually increase demand for FiscalNote services. More complexity, more confusion. Companies need help navigating that.
Like that tariff tracker example they mentioned.
Exactly. That
Okay.
apparently generated a $1 million pipeline back when tariffs were hot news.
Yeah.
More confusion can mean more business.
But there's a flip side.
There is. If those tariffs really hurt their clients financially, well, clients might face budget cuts. And services like FiscalNote's, even if useful, could be on the chopping block. So, the net effect. Uncertain. Really depends on the specifics of the tariffs and how badly they hit FiscalNote's customer base.
Okay, that gives us a really solid grasp of the business itself. Now let's shift focus to the people running the show. There have been some big leadership changes recently, haven't there?
Yes, significant moves at the top. Josh Resnick became CEO in January 2025. He comes across as having a strong operational focus. Tim Huang, the co-founder and previous CEO, he moved to executive chairman. His focus now is more on strategy, the AI vision, company culture.
And the CFO.
John Slava is still CFO and CIO. He brings financial and, importantly, M&A integration experience, which might be relevant even with divestitures. And they specifically brought in new tech leaders recently, Greg Alexander, Jerry Campbell, explicitly to drive AI development and product-led growth, particularly around PolicyNote.
How about the board structure? Anything unusual there?
Looks pretty standard, actually. Staggered terms, majority independent directors, independent committee chairs. Ticks the usual corporate governance boxes.
So how's this new team doing, especially with this massive pivot they're attempting? How's their track record looking so far?
Well, their biggest action, obviously, is that aggressive divestiture strategy we talked about, selling off those non-core bits. Financially, they've actually hit or slightly beaten their own forecasts for revenue and adjusted EBITDA in both Q4 24 and Q1 25.
Okay, hitting targets is good.
Yeah, and they achieved their first full calendar year of positive adjusted EBITDA in 2024. Q1 25 was their 7th straight quarter of positive adjusted EBITDA.
That adjusted EBITDA trend does sound like progress.
It is. And importantly, management reaffirmed their full year 2025 guidance for both revenue and adjusted EBITDA, even after accounting for the assets they sold. That suggests either confidence in the core business's profitability, or they found significant cost savings, or maybe both.
But it's not all smooth sailing, right? That NYSE notice, that's serious.
Absolutely. That non-compliance notice they got in April 25, because the stock price fell below $1, that's a very real pressure point. Management says they're evaluating options to get back into compliance, but it's a deadline they have to meet. The CEO also, to his credit, acknowledged some execution problems late last year hurt their early 2025 recurring revenue. But he said they've made changes and are seeing better pipeline growth now.
You mentioned recurring revenue ARR. That's super critical for a subscription business. How's that metric looking?
Yeah, this is probably the biggest area of concern right now. Annual recurring revenue ARR actually declined. It was down to $87.7 million in Q1 25. That's down about 7% year over year on a pro forma basis, meaning adjusted for the divestitures.
Ouch. And retention.
Net revenue retention, NRR, also dipped a bit, from 96% down to 93%. Still decent, but the trend is downwards. Management expects ARR growth to return in the second half of this year, driven by PolicyNote adoption and better sales execution.
Yeah.
But that recent decline, they absolutely need to turn that around. It's crucial.
They used to grow a lot by buying other companies, right? M&A.
Yeah, they were quite acquisitive, but that strategy completely flipped. It's all about divestiture now, focusing inward, optimizing the core.
Okay, so summing up the management picture, how would you frame it?
Look, this is definitely not business as usual.
Yeah.
The leadership changes, this aggressive pivot, it's a direct reaction to the pressures. The stock price, the lack of profit historically, the debt, the NYSE notice. It's a high-stakes gamble, really, focused on a rapid turnaround. And success totally depends on whether this new leadership team can execute this really complex plan without dropping the ball. They have to hit those targets: profitability, free cash flow, and crucially, reignite that ARR growth driven by PolicyNote.
And how are they allocating capital now? Where's the money going?
Priority number 1, 2, and 3 is debt reduction, no question. They've made huge strides. That senior term loan, down by $96 million since December 2023. It was down to about $62 million by March 25.
Wow.
That's for 60% reduction in roughly a year. The money from selling those assets is going straight to paying down debt.
And that helps how? Less interest payments.
Exactly. Massive impact on cash flow. Quarterly cash interest expense dropped from around $5 million down to maybe $2 million. That's real cash freed up.
Okay, makes sense. Are they still investing in R&D, given the AI focus? Seems important.
Well, the actual dollar amount spent on R&D has decreased year over year recently, which might seem counterintuitive, but management insists the strategic focus is still squarely on AI and PolicyNote. So maybe they're finding efficiencies, shifting resources internally, focusing the spend more tightly. Hard to say for sure, but they claim AI isn't being deprioritized.
No share buybacks or dividends, I assume?
Correct. All focus is on fixing the balance sheet, that debt reduction, and reinvesting whatever's left into making the core business grow and run better.
You mentioned ROIC earlier, return on invested capital versus WACC. Can you break that down simply?
Yeah, sure. Think of WACC, weighted average cost of capital, as basically the average interest rate the company pays on all the money it's raised from both debt and selling stock.
Right.
Let's say it's 11%. ROIC, return on invested capital, is the profit they're generating from the assets they bought with that money. FiscalNote's ROIC was negative recently, like max 13%.
So they were spending 11% to get the money, but losing 13% on what they invested in it.
Essentially, yes, historically. It strongly suggests those past acquisitions, the ones they're now selling, weren't generating good returns. It was value destroying. The whole point of the current strategy, selling assets, focusing core, is to flip that, to get the ROIC on the remaining business above that 11% WACC. But climbing out of that negative territory is a steep hill.
Okay, that really sets the scene for digging into the financials. Chapter 3, financial health. Let's get into the numbers. What's the quick snapshot?
Right. As of late May 2025, stock price was hovering around 64 cents. That gives it a market cap of just under $100 million, say $99 million roughly.
And valuation metrics at that level?
Well, PE is meaningless with GAAP losses. Price to sales is low, around 0.86 times trailing revenue. Enterprise value, adding debt minus cash, is maybe $114 million, making EV to sales around 1x. EV to adjusted EBITDA, using FY24 numbers, maybe around 11.6x. Generally, these are low multiples. It screams market skepticism or perceived high risk.
Let's track the income statement. Revenue, profitability. What are the trends?
Revenue's down year over year, about 9% in FY24, over 14% in Q125. But remember, that's mostly because they sold off businesses.
Right, the divestitures.
Yeah. The good news within that is 92% of what's left is that recurring subscription revenue, predictable. GAAP gross margin dipped slightly, but importantly, their adjusted gross margin, which arguably reflects the core ongoing business better, actually improved a bit from 85% to 87% in Q1 year over year.
Okay, so the remaining core business might be getting slightly more profitable at the gross level.
Seems that way, yeah. And operating expenses, R&D, sales and marketing, G&A, when you strip out one-off items, they are trending down. Cost control is happening. Still, the overall GAAP operating loss is significant. Operating margin was still deeply negative in Q1.
But that lower interest expense helps further down.
Hugely.
Yeah.
Dropping from $6 million to under $3 million quarterly,
Mm-hmm.
that makes a big difference to the pre-tax loss.
So the bottom line, net income or loss.
Okay, Q1 25 net loss was $4.3 million. That's way smaller than the $50.6 million loss in Q1 24. So definite progress in shrinking the loss. However, and this is crucial, that reported $9.5 million profit for the full year 2024. You have to look under the hood. It wasn't because the business suddenly started making money day to day.
It was the one-time stuff.
Exactly. Huge gain from extinguishing debt, big gain from selling assets. These were offset partly by writing down the value of other assets. Without those one-offs, FY24 would have been another significant loss.
So you really can't take that 2024 profit number at face value for the underlying business health.
Not at all. Adjusted EBITDA, though, that does show improvement in underlying operations before interest, taxes, etc. $2.8 million positive in Q1 25, up from $1.2 million a year ago. Margin improved from 4% to 10%. That shows operational progress. But getting to sustainable GAAP profit, still the main challenge.
Let's pivot to the balance sheet. You said the debt reduction was huge. How healthy does it look now?
This is really the brightest spot in the financial story right now. The balance sheet is dramatically healthier. Total debt plunged from over $155 million at the end of 23 down to about $61.5 million by March 25. That's a massive cleanup operation.
And what does that do for the risk profile?
Slashes it. Debt-to-equity ratio went from over 3x down to like 0.64x, much safer. They had nearly $42 million in cash. Current ratio improved to 1.28x, so short-term liquidity looks okay, positive working capital, and they were meeting their debt covenant requirements as of March.
Okay, much stronger footing there. What about cash flow, the actual cash moving in and out?
It's also improving. Cash from operations is getting closer to break even. It was a negative $1.9 million use in Q1 25, much better than before. That reflects the better adjusted EBITDA, lower interest paid, cost control. Free cash flow after capital expenditures still negative $3.2 million in Q1. But again, the trend is way better. Trailing 12-month FCF improved by something like $70 million compared to 2 years back.
So getting closer to that positive FCF goal.
Definitely moving in the right direction. That's management's stated goal, and Q1 shows progress. Cash from investing was positive because of the asset sales, and that cash was used in financing activities to pay down the debt.
Any other key things from the SEC filings, the 10K or 10Q?
They basically confirm all these details, the divestitures, the debt paydown, the impact on revenue. They highlight those one-time gains skewing the FY24 profit. They reiterate the focus on FCF, ARR growth for the core. Oh, and they mentioned that Q1 filing was a bit delayed due to some technical reporting stuff, but it got sorted.
Okay, let's try to pull this whole financial picture together then. What's the narrative?
The financials tell a story of transformation, really. Selling assets hurt the top-line revenue number, no doubt. But it dramatically fixed the balance sheet by getting debt under control. That was huge. Now the focus shifts entirely to making the remaining core business profitable and growing it organically. Adjusted EBITDA shows progress on operational efficiency, but the acid tests are still ahead, achieving sustainable GAAP profit, reigniting that organic AR growth, and consistently generating positive free cash flow.
All right, that covers the business, management, and the money in detail. Let's shift to the second half, how the market views all this. Chapter 4, market sentiment and analyst coverage. What are the Wall Street analysts saying?
Sentiment there seems cautiously optimistic, generally leaning towards buy or strong buy ratings.
And price targets. Given the stocks are around 64 cents, what upside do they see?
They imply pretty significant potential upside. But the range is wide, which tells you there's a lot of uncertainty baked in. Average targets cluster anywhere from, say, $2.40 up to almost $3.80, depending on the source. But the full range reported goes from a low of $1.50 to a high near $4.07.
A huge range. Why are some analysts bullish? What positives are they highlighting?
They're looking at the strategic moves, The divestitures, simplifying things, the improving profitability, at least on an adjusted EBITDA basis, the fact they've been meeting or beating recent forecasts, the reaffirmed guidance for FY25, the expectation that ARR growth will bounce back later this year, powered by FiscalNote, and of course the massive debt reduction and the clear path to positive FCF. They see a plan to being executed.
Okay. And the flip side. Why are some people good and cautious or bearish?
Well, the big red flag is that recent ARR decline and the slightly lower retention. That shows current weakness in the core. There's also the near-term revenue hit from selling assets, the long history of GAAP losses, and the need to prove they can actually achieve sustainable profit, not just adjusted profit.
Now, maybe a more direct signal of market sentiment is short interest. What's that look like?
Yeah, this is really key for understanding the skepticism. Short interest is high, very high actually. Sources reported anywhere from over 10% up to potentially over 25% of the float.
Wow.
And the days to cover ratio is also pretty high, meaning it would take quite a few days of average trading volume for all the shorts to buy back their shares. It means a significant chunk of the market is actively betting against this stock. They think the turnaround fails or the price goes lower.
High short interest. That can also lead to volatility, right? Short squeezes.
Exactly. If some unexpectedly good news hits, all those shorts rushing to buy back shares could theoretically drive the price up very quickly. But it's a double-edged sword. That high short interest exists because there's strong bearish conviction out there.
Any clues from the options market?
There's definitely trading activity. The put-call open interest ratio was low recently, maybe suggesting slightly more bullish bets or hedging. Hard to say definitively. What is clear is that implied volatility has spiked really high at times over the past year, meaning the market was bracing for big price swings.
So putting it all together, the market sentiment picture is...
It's really split, isn't it? You have analysts looking at the strategy and recent execution points leaning optimistic, but then you have this very high short interest, a loud signal that a large segment of the market remains deeply skeptical about whether FiscalNote can actually pull off this turnaround given the challenges ARR, profitability, competition, and execution risk.
Okay, let's move on to who actually holds the stock. Chapter 5, ownership structure. Is it mainly institutions or insiders?
It's a mix, but institutions definitely hold a significant chunk. Estimates vary quite a bit, maybe 23% to over 50% of the float, depending how you count it. Held by, dozens, maybe over 150 different institutions.
Any particularly large institutional names that pop up?
Yes. Meso Capital often gets mentioned as having a very large stake, possibly the single biggest holder. Then you see the usual big names, BlackRock, Vanguard, Morgan Stanley, also Kennedy Capital, Geode, iShares, State Street. Looking at recent activity like late 24, early 25, it's mixed. Some adding shares, some reducing or getting out completely. Shows active management during this volatile period.
What about the insiders, the founders, executives, directors?
Insider ownership is notably high here. Reports range from maybe 13–14% up to over 40%. That includes the co-founder, key execs, board members. Top holders include Manoj Jain from Meso Capital, Director Keith Nilsson, CEO Josh Resnick, Exec Chairman Tim Hwang, CFO John Slabaugh, GC Todd Amon.
Having high insider ownership, that can sometimes align interest with outside shareholders, right? They want the stock to go up too.
Can be seen that way, yes. Their fortunes are tied to the company's success.
But what about their recent trading activity? Are these insiders buying more shares or selling?
This is definitely something investors need to be aware of. The trend in reported insider trading over the last, say, 6 to 12 months has been heavily weighted towards sales. One source counted something like 26 insider sales versus 0 open market purchases in a recent 6-month window. Key people like Hwang, Resnick, others have reported selling shares. Tim Hwang, the exec chairman, sold some back in March 25, around $1.13.
Does that mean they lack confidence?
It's not automatically a negative signal, but it's a data point you have to consider. Insiders sell for lots of reasons: diversification, taxes, needing cash. It's not always about pessimism. You need to look at the size of the sales relative to their total holdings. Interestingly, some broader NASDAQ data showed net shares bought by insiders over 12 months, but that might include things like option exercises, not just open market buys. So the picture is a bit nuanced, but the recent open market trend is clearly sales.
Any signs of traditional shareholder activism, hedge funds pushing for changes?
Not really mentioned in the sources, no. But yeah, you could argue that the whole exploration of maybe taking the company private, which was initiated by Tim Hwang when he was still CEO, that could be seen as a form of insider-led activism.
Yeah, right.
A signal of frustration with the public market valuation.
Yeah, fair point. So boiling it down, what are the main shareholder concerns right now? What's keeping them up at night?
Well, number one is obviously the poor stock performance and that looming NYSE delisting threat. Number two, the absolute need to get to sustainable profitability and positive FCF. Three, reversing that ARR decline and getting organic growth back. Four, managing the remaining debt. And five, potential dilution risk from things like that recent filing to potentially sell up to 12.5 million more shares.
Okay, summing up ownership.
You've got significant insider and concentrated institutional ownership. These groups hold a lot of sway. Their main focus, like all shareholders, has to be the success of this turnaround. The ongoing insider sales, though, that's definitely a factor to keep an eye on.
Right. We've hit the business, the management, the money, market views, ownership. Now for the really crucial part for anyone considering this, the risks.
Chapter 6, Risk Assessment. And yeah, with a turnaround play like FiscalNote, the potential rewards might look big, but the risks are equally substantial. You have to weigh them carefully.
Let's break them down, starting with risks specific to FiscalNote itself.
Okay, top of the list has to be execution risk. This whole plan, selling assets, focusing on policy note, integrating AI, cutting costs, moving customers over, it's incredibly complex. It requires near flawless execution by this relatively new leadership team. If they stumble anywhere significant, the whole thing could unravel.
Then the revenue risk.
Exactly. ARR and customer retention risk. That recent ARR decline is a huge warning sign. They must turn that around and show organic growth from the core business while keeping their 4,000-plus clients happy and sticky. If ARR keeps shrinking, the core business itself is shrinking. That's bad. Then profitability and FCF risk. Yes, adjusted EBITDA is better, but the history is GAAP losses. Getting to sustainable GAAP net income and consistently generating positive free cash flow, that's the real financial hurdle. It's not guaranteed. Remember, 2024's GAAP profit was an accounting mirage from one-offs.
And the debt in listing.
Still risks. Debt and NYSE listing risk. Debt is lower, but they still have it, and covenants to meet. And failing to get back into NYSE compliance, that risks delisting, which kills liquidity, hurts confidence, potentially forces some funds to sell. It's serious pressure. Also, product and technology dependence risk. Their future is riding heavily on policy note, and its AI being great and truly different. If the AI underwhelms or they have issues with third-party data they rely on, the whole strategy takes a hit.
What about people or integration issues?
Definitely risks there too. Talent risk. Attracting and keeping top AI and salespeople during a turnaround, especially with stock price pressure, is tough. And integration risk. Even after selling stuff, lingering issues from past acquisitions, like maybe a clunky user experience noted by some, could still hinder operations. And relying on U.S. government contracts always carries risk related to budgets or losing contracts.
Okay, shifting outside the company. Broader industry and market risks.
Intense competition is huge. They're not just fighting startups, they're fighting giants like LexisNexis and Bloomberg who have deep pockets and are also investing in AI. FiscalNote needs real differentiation, rapid tech change. The AI world moves incredibly fast. They have to keep innovating just to keep pace, let alone lead. Macroeconomics. If the economy tanks, client budgets get squeezed. That could hurt demand. And regulatory changes around AI itself or data privacy could impact how they operate or what they can offer.
Any other financial specific risks?
Well, the history of losses underscores that future profit isn't a given. The low valuation and sentiment, high short interest, means the stock is fragile and volatile. There's capital needs dilution risk. If they burn cash longer than expected, they might need more money, potentially selling more stock, like that secondary filing, or taking on more debt. And impairment risk. If performance falters, they might have to write down the value of assets further.
And that hypothetical U.S. tariffs risk, where does that fit?
It's an indirect market risk. The risk isn't the tariffs themselves hitting FiscalNote, but rather hitting their clients so hard financially that those clients cut spending, even on policy intelligence tools. It's a second-order effect.
Okay, summarizing the risks overall.
Look, the risks are significant, they're varied, and they're very real. That low stock price isn't an accident. It reflects the market pricing in these challenges: execution, AR growth, profitability, competition, the NYSE listing. Investing here absolutely requires believing the potential reward justifies taking on these substantial risks of failure.
Which brings us nicely to our conclusion. Let's try and pull all these threads together.
Okay, FiscalNote. It's a company right in the thick of a major high-stakes turnaround. They've made bold moves, shedding assets, slashing debt, to laser focus on core AI-driven policy intelligence via the PolicyNote platform. They've shown real progress on fixing the balance sheet. That debt reduction is impressive. And they're making strides on operational profitability, shown by that improving adjusted EBITDA. Management sounds confident they can hit their 2025 targets and get to positive FCF.
But as we've hammered home, the challenges are serious.
Absolutely. The history of gap losses means true profitability is still an aspiration, not a reality. That recent dip in ARR, a major hurdle they have to clear with organic growth. Competition is fierce, demanding real AI differentiation. And that low stock price, high short interest, and NYSE notice. They scream market skepticism and immediate pressure.
So if you're looking at this through a value investing lens, how do you frame it?
It's definitely a special situation or turnaround play. It's not a stable, high-quality compounder right now. The subscription model is attractive, yes. The market growth potential is there. But the strength of their competitive moat, the AI, the brands, the switching costs, is really being put to the test. Trying to calculate an intrinsic value today. Highly speculative. It totally depends on management nailing the execution of this pivot.
If someone is watching FiscalNote closely, what are the absolute critical metrics or milestones they need to track? What tells them if the turnaround is actually working?
Okay, key things to watch. Number one, are they showing organic ARR growth returning in that core business? Forget reported revenue gymnastics, look at organic growth. Two, are customers actually adopting and engaging with PolicyNote? Is net revenue retention ticking back up? Three, are they consistently generating positive free cash flow, not just adjusted profit? Four, how do they resolve that NYSE compliance issue successfully? Five, can they demonstrate convincingly a real AI differentiation that stands up to competitors? Those are the big ones.
So let's circle right back to where we started, that $0.64 share price and the NYSE notice. How does FiscalNote's whole strategy, this big AI bet, connect directly to that reality?
That super low price and the NYSE notice, they're basically the market flashing giant warning signs about the risks and skepticism. FiscalNote's entire aggressive strategy, the AI-focused selling assets, paying down debt, it's their direct attempt to answer that skepticism and overcome those risks. They're betting that by becoming this leaner, focused, AI-powered company with a clean balance sheet, the remaining core business is actually worth way more than 64 cents a share. If they pull it off, the potential return from this low base could be very significant for investors willing to stomach the risk today.
It's fascinating. A company basically betting its future on AI transforming this really complex niche, all while facing these intense financial and market headwinds. It does make you wonder.
What's that?
Well, if FiscalNote's success really boils down to whether their AI can cut through the policy noise better than anyone else, what does that signal about how AI might reshape other super complex, data-heavy industries? And, maybe more pointedly, can a company under this much pressure truly lead that kind of tech transformation?
That's definitely something to think about as AI keeps evolving everywhere.
And remember, you can request stocks for us to deep dive on. Check out stockanalytics.ai for more analysis, especially around earnings time.
Yep, and don't forget to subscribe to the stockanalytics.ai YouTube channel for ongoing updates and analysis.
As always, please remember, this deep dive is purely for informational purposes. It is absolutely not investment advice. Investing carries significant risk. You must do your own thorough research and consult with a qualified financial advisor before making any investment decisions.
Thanks for joining us on this deep dive into FiscalNote Holdings. We really hope it gave you a clearer, more distilled picture of what's going on there.
And a big thank you to you, the listener, for providing the sources that made this detailed discussion possible. We love getting your requests and might dive into yours next.
Until next time.